Domino's Pizza Stock, ticker symbol DPZ. This stock is down 44% year to date, which is insane. DPZ stock has a 52-week high of $567 and a 52-week low of $300. So with the current stock price of $309, they are around the 52-week low. But does this mean that DPZ stock is a buy at current prices? In this video I'm going to show you real quickly what Domino's Pizza does, the historical returns, the fundamental analysis, dividends, some competitors, and in the last part I'm giving you my price target to see if they are a buy or not. And I think you definitely want to see that part, so make sure to watch until the end. And I'm also very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So, what does Domino's Pizzas do? Domino's is a restaurant operator and franchisor with nearly 19,000 global stores across more than 19 international markets. Domino's is the largest player in the global pizza market, ahead of Pizza Hut, Papa John's and Little Caesars. If we dive in the latest quarterly results, we see a few interesting things. First of all, there is a global retail sales growth of 1.5% excluding foreign currency impact. US same-store sales declined 2.9% and international same-store sales declined 2.2%. Diluted EPS is down 7.8% to $2.82. So to be honest, this isn't very good. Maybe people are not buying pizza at Domino's because of inflation. Maybe people want to eat healthier and skip the pizza. A fact is that the same-store sales is declining. This is also reflected in the 3-month quarter and 6-month quarter results. Both show us a decline in net income even with less shares outstanding. Revenue increased 32 million or 3.2% in the second quarter year over year, primarily to higher supply chain revenues and higher basket pricing. Prices increased 15.2% during the second quarter. So, with the same-store revenue growth declining, another way to get revenue is by opening new stores, and that's exactly what Domino is doing. But the thing is that it's mainly international stores, which have lower margins versus domestic stores. So it's expected that they will bring in new revenue, but at lower margins. On top of that, I think it's very good to open new stores to increase revenue. But to me, the same-store sales is more important for Domino's right now. The previous guidance for the increase in prices was 10 to 12%, but Domino's updated this price increase to 13 to 15%, which is a big increase in my opinion. This will of course bring in more net income, but on the other hand, this might cause a further decrease in same-store sales. When we check the revenue breakdown, we see that supply chain is by far the biggest segment, representing 60% of the total revenue. The good thing is that this segment is growing the most year over year. US company-owned stores and franchise are both declining year over year, and each represents 10 and 12% respectively of the total revenue. International represents only 6% of the revenue. And now that we know more about Domino's Pizzas, it's time to check the historical results to see what happened there. I decided to include the S&P 500 as a benchmark, since this is one of the easiest ways to invest. Just buy an S&P 500 ETF and wait. Next to that, I decided to include Papa John's, ticker symbol PZZA, and restaurant brands, international, ticker symbol QSR. And to be honest, both ticker symbols are pretty funny. PZZA is quite obviously, and QSR is abbreviation for the quick serving restaurants. On the 5-year chart, we see that Domino's did beat the S&P 500 including dividends, which kinda surprises me after the big drop, but it has to be said that it's only by a small margin. Domino's returned 60% versus the S&P 500 returning 56% on the 5-year chart including dividends. PZZA and QSR both had a low return of 6% and minus 5%. And a lot of people are pointing out to the fact that the lockdown periods pushes the stock prices down. But to be honest, pre-COVID, these stocks didn't outperform the S&P 500 either, except for Domino's, so that's something to keep in mind. On the 1-year chart, things are getting ugly. Domino's had a minus 34% return, while the S&P 500 had a minus 16% return. PZZA returned minus 45%, QSR returned minus 12%. On the 6-month chart, it's pretty much the same story. DPZ stock returned minus 20%, while the S&P 500 returned a minus 18%. PZZA returned minus 34%, and QSR returned minus 10%. On the 1-month chart, it's still a negative return with a minus 13% for Domino stock and a minus 8% for the S&P 500. PZZA is at minus 70% and QSR is at minus 12%. So things are looking very bad for these stocks. But this could also be interesting to see if Domino stock could be a buy based on the fundamentals. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe and in return you receive similar analysis to this one every week. Let's continue by diving into the fundamentals. Domino's is a 11 billion market cap company with a PE ratio of 23, which is just below the 5-year average of 26, so that's the good part. But 23 could still indicate that this company is overvalued. Later in the video I will give you my 3 price targets to see if Domino's is a buy, so make sure to watch until the end. Next up is revenue. Domino's has a trailing 12-month revenue of 4.4 billion, and in this graph we see that revenue went up really nice and steady. But since 2021 it went flat, and this is something to keep your eye on. Net income is at 469 million, which gives us a profit margin of 10%, which is pretty good for a company like Domino's, but keep in mind that it's lower than the 5-year average of 11%. And I think margins will decrease, maybe even more. US same-stores revenue is decreasing and they don't open new stores in the US that much. They are opening almost all the stores internationally, which has lower margins, so if the international segments becomes bigger and bigger, the margins will slowly decrease. On the other hand, Domino's is increasing the prices, so we need to see what's going to happen with the next results. Next up is return on assets, which sits at 24% and looks pretty good to me. Return on equity is at minus 11%, so definitely keep an eye on that one. And now the most important number, return on invested capital. To be honest, this is quite impressive. It's sitting at 37.8%, which is really high, and also above the 5-year average by a small amount, so I definitely like this number here. A thing that I don't like is the total amount of debt. Right now, total cash is sitting at 114 million, and operating cash flow at 512 million. Leveraged free cash flow is at 334 million, but the total amount of debt is sitting at 5 billion, so they are not capable of paying down at least a third of the total debt. So to me, this is something to keep your eye on. So it's very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, do acquisitions, open new stores, pay dividends and all other things. And they are doing a great job here. It's growing over a longer period of time, which is great. Another thing that I like to see is when a company is buying back shares. But keep in mind that you want a company to buy back undervalued shares and not overvalued shares, otherwise it might not be very efficient. In this graph we see that shares outstanding are going down, which is great. This will increase the EPS, lower the PE ratio and of course make it easier to maintain and increase the dividends. On top of that, you will own more of the business. And since we're talking about dividends anyway, Domino's has a dividend yield of 1.4%, which is pretty decent. Annual payout is at $4.4 a share or $1.10 each quarter. Payout ratio is pretty good at only 31%. This means they have roughly 70% left in cash to pay down debt, buy back shares, open new stores and all other things. The 5-year growth rate is at 19%, which is pretty impressive. And they grew the dividends for 8 years in a row. Overall, a great dividend growth scorecard in my opinion. And with the stock price coming down that much, dividend yield only goes up. Next up are the fundamentals of Domino's versus some major competitors. I decided to include Papa John's Pizza, ticker symbol PZZA, and Restaurant Brands International, ticker symbol QSR. QSR is by far the biggest company in terms of market cap. Both PZZA and QSR have a lower PE ratio versus Domino stock, so they are the winner here. DPZ has a 1.78% revenue growth year over year, while both PZZA and QSR have a higher number here. But Domino's has the highest 5-year revenue compound annual growth rate. QSR has the highest net income compound annual growth rate. Domino's has the lowest gross profit margin, but the second highest net income margin, and second highest levered free cash flow margin. Return on total capital is the highest at Domino's. All companies seem to have a lot of that compared to the cash position, which can be lockdown period related. Domino's has the lowest dividend yield and QSR has the highest. Payout ratio is the lowest at Domino's, but QSR has the highest dividend growth rate. Domino's has the most consecutive years of dividend increases. Overall, I think Domino's didn't outperform these competitors and this is something to keep in mind. But let's check the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. I expect things to slow down a bit versus the 5 and 10 year averages, so I'm filling in 1% on the low assumption, which is roughly the last year growth number, 4% for the mid assumption and the 7% for the high assumption. For the profit margin, I expect a range of the numbers displayed here for the 1, 5 and 10 year average. So I'm filling in 9% for the low assumption, 10% for the mid assumption and 11% for the high assumption. It's the same story with the free cash flow margin. PE ratio is at 23 right now, which is too high to me, even after the big drop in stock price earlier. Domino's has some growth potential internationally, but they already are pretty big, so I don't want to overpay for this growth. That's why I'm filling in 20, and it's the same story with the price to free cash flow. For my desired annual return, I fill in 12.5% since I can get an easy 10% average annual return with owning an ETF long term, and I want to build in a margin of safety. Right now, Domino's is at $307 as of recording this video. I hit analyze, and we only see red numbers. We have a low price target of $138, a mid price target of $191 and a high price target of $264. So according to these numbers, Domino's is overvalued. And to be honest, the mid to high price range seems the most justified here, to me. And it needs to drop around a third of the current stock price to become an interesting value play. My final conclusion on this stock is that right now Domino's is overvalued based on what we analyzed. I hate to see when same store sales is declining, and this is something that worries me a lot. A lot of fundamentals look pretty good, so I want to analyze this company from time to time. But right now I'm skipping this stock since it needs to drop roughly 30 to 40% in stock price. But remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.